Take a look at Amazon shares if you haven't already. Stock is slipping on the back of that revenue forecast. Rob Sanderson joins us today. Loop Capital Management, a senior internet analyst, joins us with a buy rating, targeted 275. Rob, we always talk about their forecasts being often wide enough to drive a truck through. Did you see last night's as weak?
A little bit soft on the outlook. Yeah, I mean, we're a touch surprised, not terribly surprised. We sort of know that the spending environment is just sort of so-so. There's, unit growth is good. There's a mix down to lower ASP, everyday essential type products. We were really encouraged by the trends in the cloud business, obviously, and the retail margins, as mentioned. I think that's a real big piece of, what why we're bullish on Amazon for the next few years is there's a lot of room for upside here as they get their cost to serve back to historic levels. Although they are hitting all-time highs in retail margins, that business is much richer from a margin perspective than it was historically because the advertising side is so much larger and the margin upside is still pretty significant as they get cost to serve back to historic levels.
Right. And that's a continuation, that margin story from some prior quarters. So does that allow them the wherewithal to be aggressive on things like CapEx overall?
Oh, yeah. And a lot of that CapEx obviously is cloud related, and that's a different subject. But yes, they've got lots of capacity to spend. The earnings power in the model getting back to historic levels. They say their true north is 2018. That's something like $40 billion higher in operating income if they can get all the way there on our next year's numbers. So that's going to take a few years to get to, but there's a lot of upside in terms of earnings power in Amazon.
The advertising business, I'm just curious, Rob, because it's becoming a more and more important component, I would think, of profitability. What are we talking about? $17.3 billion of revenue for the last quarter, 18% year-over-year growth. And to put it in perspective, they're running at, almost $70 billion annual run rate, which is double what they had 4 years ago. How important is that to your overall thesis?
Very important. It's a real big piece of the margin driver. I think the larger piece is getting, again, back to historic levels on cost to serve. But that advertising business is a juggernaut. And they've been really successful at understanding shopper behavior, shopper data, surfacing that for brands and merchants to target users. They've been really good at doing that on site. But all these efforts with their DSP and the connected television and the investment in sports and all of this, ad network is extending that beyond the site and across the whole internet. So there's a really powerful, long-term story still ahead for Amazon in the advertising space.
What about retail? I mean, are they underestimated on the retail story? I just mentioned the better profitability there. Or do you think the market appreciates it?
I think the market's missing how profitable the retail business overall is. Another way to say that is how poorly the unit economics on fulfillment have fallen. It's been masked by the subsidy, call it, from advertising and commissions, which is essentially, mostly margin. So I think it's what people are missing is how bad the unit economics and fulfillment had gotten, and therefore how much better it can get as it returns to normal.
Rob, important print for sure. Thanks for the help with that. We'll talk soon. Rob Sanderson over at Loop.